Okay, so the Federal Not-for-Profit Corporations Act has already been proclaimed in force. So if you're from a federal corporation, you can certainly start, if you haven't already done so, start the continuance process, which must be completed by October 17th of 2014. And the risks that you face if you don't complete it on a timely basis is that Industry Canada can dissolve your corporation if you don't continue on time. And if you are dissolved by Industry Canada, then Revenue Canada can and will revoke your charitable registration. So it's very important to get this process moving, to get it done on time. It's a simple process to continue. The more complicated part is reviewing your bylaws to make sure that they're in compliance with the new provisions of the new act. But you have another year to amend your bylaws, so you can simply continue under the act, amend your bylaws on a more comprehensive basis after the fact. The Ontario Act has been pushed back a little. It was originally expected to be proclaimed in force January 1st, but there have been some amendments that were introduced that are being debated in the fall of this year, and so the earliest expected date of proclamation now is July 1st of 2014. So it's just bought you another 6 months to get organized and get your affairs in order. So that's the timing and the transition. In terms of the transition under the Federal Act, you do need to take active steps to transition. For the Ontario Act, you don't necessarily need to. There's no formal transition process. The Act simply begins to apply when it begins to apply. And what happens is for newly incorporated organizations under the Act applies holus bolus. For those already in existence, if your bylaws are silent on a particular point, then the Act will apply and the Act will govern. If your bylaws are inconsistent with the Act, then you have another 3 years to transition yourself so that you come into compliance with the new Act. And if you don't transition, then the Act trumps your bylaws and they roll. So one of my good ideas was for the organizations to consider whether or not they're happy with their venue, their jurisdiction, whether they're happy with the Canadian jurisdiction or whether they prefer the Ontario jurisdiction or vice versa. Because what you can now do, which you couldn't before, is transition from one to the other quite easily. And the factors to consider as to which jurisdiction you prefer are the following. The first is a national platform. A lot of organizations do like to incorporate under the federal legislation because this gives them a national platform and it enables them to use their name across all the provinces without any problems. If you're an Ontario corporation and you decide that you want to expand your activities to other provinces, you may, to your chagrin, find that that name is unavailable in a different province and you would have to expand your activities in a different way under a different name. In terms of financial transparency, the Federal Act requires that annual financial statements are filed, and these are open to the public. And so any charities or any individuals that are seeking donations from the public can say, look, we're open and transparent. You can always check our statements and get a good sense of where we're at. There's not the same venue for Ontario corporations, but that's not to stop you from filing your financial statements and posting them on your website and saying we're equally as transparent. But that's a voluntary act, it's not a mandatory act. And some donors might not look as favorably upon this if it's not something that's authorized and regulated by government in terms of that filing. There are provisions where you can waive the appointment of a public accountant and have a compilation report as opposed to an audit or review engagement. This might be important to you, to those organizations that don't have a lot of money to spend on accountants and others. So under the Federal Act, you can waive the appointment of a public accountant where your annual revenues are less than or equal to $50,000, but all members entitled to vote on this resolution to waive must be in agreement with this. Under the Ontario Act, the threshold is $100,000, so it's a bit of a higher threshold where you can waive it. But in Ontario, you only need 80% of the members to support the resolution. In terms of review engagements instead of an audit, a soliciting corporation under the federal jurisdiction whose annual revenues are less than or equal to $250,000 can have a review engagement instead of an audit but if the annual revenues are greater than $250,000, a public audit is required. And under the Ontario legislation, you can have a review engagement if your annual revenue is less than or equal to $500,000. If it's greater than that, you must have a public audit. In terms of distribution of any residual property upon any liquidation or dissolution, under the federal legislation, your property must be distributed to a qualified donee. So it can be any other charity in Canada or any other organization that is defined as a qualified donee under the Income Tax Act. In Ontario, it has to be a qualified donee, but it must be an Ontario corporation. So that limits who you could or couldn't distribute your residual property if you were to dissolve or liquidate. In terms of supervision by the public guardian and trustee, in Ontario, you do need PGT pre-approval if you were to continue under a new name or if you were going to do any other fundamental acts. That is not the case under the federal legislation, so you have a little more freedom and a little less restriction in terms of how you function. Under both acts, you have to have a minimum of 3 directors. In Ontario, you can have ex officio directors. Under the federal act, you cannot. But there are workarounds. So for those organizations that have always had a president and CEO, for example, or executive director, as an ex officio director, what you simply need to do is amend your nominations policy and ensure that that is one of the skills-based board members who you'd like to nominate to the board, and you deal with this individual through an election process as opposed to automatic appointment to the board because of the position that that individual holds. In terms of bylaws, under the Federal Act, you must file your bylaws with Industry Canada. Now, Industry Canada used to review your bylaws and approve them, and they weren't in effect until the Minister of Industry would approve them. Now there's no review approval process. They just want to keep them on file, but you do have to make that filing for any bylaw amendment. In Ontario, there's no filing requirements, so your bylaws are considered private. In terms of annual returns, under the Federal Act, you must file an annual return every year. If you do it online, it costs $20. If you do it on paper, it's $40. There's no annual return requirement under the Ontario jurisdiction. So again, it's another administrative issue that needs to be dealt with for federal corporations. And then the issue of proxies. In Ontario, proxy solicitation is mandatory, whereas under the federal legislation it's not. However, you can opt out of proxy solicitations by providing for other means of having absentee members vote at a members meeting. So the question that I will have you consider when we break out into your sessions is, do any of these issues make you consider possibly changing your jurisdiction of incorporation? Yay or nay? And I'm asking really more out of curiosity. I haven't seen a huge impetus of organizations changing venues because they want to save $20 a year. But there might be other issues in terms of privacy or accountability or filing requirements that you might consider important to you. Okay, second good idea is for you to consider your membership structure because of the change of provisions in both the federal and the Ontario Acts. So historically, members have had very, very limited powers. They've had the power to attend members' meetings, to receive financial statements, to elect directors, to appoint auditors, to confirm special resolutions, which are those resolutions where fundamental changes are made, such as amendments to your articles or your bylaws or any amalgamations or asset sales. And they have been able to call special members' meetings, but only for very limited purposes. And those purposes are those within the purview of the members' existing powers. Under the new acts in both Canada and Ontario, the members are going to have enhanced rights. These are significantly enhanced rights. And some are concerned that these could fundamentally influence the influence of members on corporate governance, and they would make elected directors directly accountable to the members. And bear in mind, the members are not shareholders. They don't own the corporation. they're stakeholders, but they're usually one set of stakeholders because not-for-profit charitable corporations have a multitude of stakeholders. They're accountable to their donors, they're accountable to their funders if they get government funding, they're accountable to the community members for whom they provide services. It's not just the corporate members to whom they're accountable. But under the new laws, the corporate members have fundamentally new rights. And so what is chief among these new rights is separate class voting, even for non-voting members. So some organizations have traditionally had voting members, and sometimes that's the case when only the directors are the voting members. But they sell memberships for $5 or $25, and others can become non-voting members simply because of the donation that they make to the organization. Now, these individuals were never intended to have any sort of pull or influence over the direction of the activities and affairs of the corporation. Under the new legislation, they will. So, what they do is they effectively get the ability to vote on certain matters, even though voting was never intended. So what it's called enfranchisement is what the lawyers are calling it, and it confers voting rights on what are otherwise non-voting members. And the other right is effectively a separate class vote for that class of members. So even where, under the Articles, a class of members is not intended to vote, when they get these enfranchised votes and separate class voting, they can essentially have the power to have a minority veto over the direction that the board takes because of their new rights. Now, some of this can be managed through very careful drafting of the articles and the bylaws, but there are still some irreducible class rights, meaning there's nothing that you can do to remove these rights from the members. And these apply when there are any kinds of amendments to the Articles of Incorporation that would affect the rights of a member class. You can't make that change without having that class vote on that amendment. If there's an issue with respect to amalgamations or a sale of property, then again, the members do have the right to vote. And I find that this has become more and more important in the hospital sector when you're seeing more hospitals amalgamating, potentially more health service providers amalgamating because of the efficiencies in having fewer organizations deliver the same services, then the members do have a vote on very significant business decisions. So the good news is that because Bill 85 was recently introduced, was being debated very recently, you still have 3 years to consider this new right and to transition yourself so that if you have non-voting members, you consider whether you want to get rid of that class altogether and avoid the issue of non-voting members getting the vote. The other issue with respect to only the Ontario Act, not the Federal Act, is that there's a new bifurcated bylaw amendment process that's been introduced. So generally, for most bylaw revisions, it's still going to be the same process, where the board passes a resolution to amend the bylaws, but those are not effective until the members confirm them by resolution, and often by 2/3 resolution. Now that there are certain bylaw amendments that cannot be passed or that are not effective until the members have approved them. So they don't take effect until they've been passed by a majority vote of the members. And these deal with only 4 issues. One is an add, change, or removal of provisions respecting the transfer of membership or the sale or gift of membership interests. Another is the change of manner in which you give notice to members. Another is the change of method by which members can vote at meetings, whether it's by ballot or by proxy or by telephone at a telephone meeting. And then there are certain related and interpretive definitions that can't be changed without going through this new kind of approval process. And then finally, both acts, both the federal and the Ontario acts, they contemplate certain statutory membership remedies, which never existed before. And among them is members will be able to initiate proposals at a members' meeting. And this can be risky when the board hasn't had sufficient notice to deal with these kinds of members' meetings. And you can just contemplate if a membership wanted to, let's say, take over the board, they can propose a resolution at a members' meeting saying, we resolve to remove every single director from the board and to appoint our own slate. And this can take place without any notice to the governance committee or to the board of directors. And so it's an issue that really does need to be seriously contemplated. There's also enhanced abilities for the members to apply to the court if the members feel that the directors are not acting in the best interest of the corporation and they need somebody to intervene. So there is an increasing concern about the ability of members to be able to influence the governance decisions of an organization or to circumvent certain board policies and positions and activities. And it could make it increasingly more difficult for the board to fulfill its accountability requirements and its fiduciary duties. Because keep in mind, members do not have these fiduciary duties, only the directors do. So the question that I will ask you to consider at your tables is, what membership model do you have now? And do you think that it may be appropriate to revisit it and to amend it given these new rights that members will have in the future? Third good idea deals with protecting your board from a hostile takeover. So I've alluded to this already in talking about the membership rights. And there's a wide range of corporate membership practices in the not-for-profit and charitable sectors. And the current trend is to a model where the directors and the members are one and the same. And this is what we call a closed membership model or a self-perpetuating model. And this is particularly the case for those organizations like Ontario Hospitals, where there's a misalignment between the accountability of the board to stakeholders arising from legislation, from the common law, from funding agreements, or from other requirements and expectations, and the ability and will of corporate members to influence strategic directions that are taken by the board and to circumvent board processes or to effectively veto board directions. And these types of destabilizing actions make it increasingly more difficult for the board to exercise its role and fulfill its fiduciary duty. So we have seen examples in the Ontario hospital sector where corporate members have attempted to or have succeeded in overthrowing the board. And we've seen examples where the government has appointed supervisors as a result. So the supervisors step into the hospital, they take the role of the board, they take the role of the members, and they effectively clean up the membership model, and the end result typically is a closed membership model where the directors and the members are one and the same. And this is what they've done in order to ensure that the hospitals can fulfill their requirements to the government, to the local health integration networks, to other funders, charitable donors, and the communities and the public that the hospital serves. So the Ontario Hospital Association has published a guide to good governance, and it has cited examples of multi-site hospitals that face particular challenges when they've sought to introduce service alignments among their various campuses, driven by the hospital's contractual and funding obligations to the LHIN. So in such cases, what you've seen is a lot of organizations in one region, one geographic community, trying to attempt to prevent a service realignment. So we don't want this service or this emergency room closed in our region. We want it open. Even though nobody uses it, we don't really need it, it's not the best use of the funding, we still want it because we live here, and it's a bit of a not in my backyard kind of response. And so what the members have done is they've tried to overthrow the board to prevent the service realignment and have caused destabilizing actions. So it's prevented the hospital fulfilling its obligations. So in my view, if you take anything away from this, I strongly urge you to go and look at your membership models and consider who your stakeholders are and who you're accountable to. For some organizations, it's perfectly well for the members to be the ones who are in control, and those are often social clubs and things, golf course type clubs or social clubs where the members really are the ones to whom the organization is accountable to. But for those charitable organizations receiving donations from the public or from government or funding from government or who are serving a broader community, then you really do need to consider who it is you're accountable to. You need to ensure that your board can act in the best interest of the corporation and fulfill all of its multiple accountabilities. So in my view, the best membership model is the closed membership model, but it might not work for everyone. There are other options that are available as well. So there's some who use a hybrid model where you have two classes of members. And the first class is the directors, so the directors are the members, but then you have a second class, and that could be where the directors feel they need more individuals on so that they can have the members fulfill other roles. So it would be the directors who would choose who those other individuals are or corporations are to fulfill a membership role. You can also have articles developed now where a member or a certain class of members have more than one vote. So a lot is possible as long as you're creative, and what you need to do is consider what you need to achieve in order to ensure that your organization is fulfilling all of its different accountabilities and activities. Another issue that you should consider is your nominations process. So one way of protecting your board from a hostile takeover is by having an open, transparent nominations process that is typically run by a governance committee. So you see governance committees try to establish skills-based boards where you identify what skills you need on the board. You try to recruit the individuals to fill these roles. It's carefully thought out. It's not accidental. It's not somebody who's simply been nominated from the floor and you're fulfilling your governance duties that way. Typically what would happen is the governance committee would fill a slate and they would propose an entire slate to the board. The board would approve it and would typically then propose it to the members, and the members would elect the directors. So one area of concern is under the Ontario Act, you can still have that process, but you have to bear in mind that the members can still circumvent the process by saying, we don't like your slate. Here's the slate that we want. This is who we're electing. And best intentions run amok, I suppose. So you have to be aware of all of these issues. Under the Federal Act, what you can also do is to have an advance notice bylaw, where you can say, fine members, if you want to propose somebody for election to the board, you have to give us X number of days notice, and we need to provide that notice to each of the other members. And that way there's no surprises the day of the meeting. This, unfortunately, I don't think is permitted under the Ontario Act, but it's a good alternative for federal corporations. And then finally, one other thing that you should consider is, if you don't have it already, is having a staggered board, where typically individuals are elected for a 3-year term. So you might start the staggering by having a third of the directors elected for 1 year, a third for 2 years, a third for 3 years, and then thereafter people are replaced every 3 years. And what you can do that way is ensure that you don't have a full slate retiring at the same time and a brand new slate being elected at the same time. You're doing a lot of good towards succession planning and retaining corporate history on the board, and it makes for a much better governance model. So the question I would ask you then is, what protections do you have in place to ensure that you can protect your board from a hostile takeover? Finally, fourth idea is protect your board from litigation initiated by members. So this is a good idea that relates to those corporations who have an open membership model, meaning you can have 100 members or a large number of members as opposed to the closed membership model. Now, the corporate statutes provide several ways in which members can take action against the directors. And the first is what's called the oppression remedy. So this is a very broad remedy available to a member of a corporation who thinks that the board has acted in a manner that was oppressive or unfairly prejudicial to the member or disregarded the member's interests. So an example of this might be where a member thinks that the board has proposed, in violation of the Act, a plan to get rid of a class of members or to reduce the rights of a certain class of members. So in that case, the member could go to the court and sue for the oppression remedy, and the court would then reverse the board's decision if they're successful. The second is the derivative action. And this allows a third party to require the corporation to take action against the directors. So there might be circumstances in which a member wishes to seek redress on behalf of the corporation for a director's breach of the corporation's rights. So for example, where the directors have breached their fiduciary duty, a member couldn't launch that suit because the duty itself is actually owed to the corporation. It's not owed to the member. However, the member can still sue the directors on behalf of the corporation by way of a derivative action. And finally, the members now have greater statutory rights to go to the court, to compel the court to comply with the corporation's articles, bylaws, or governing statute. So an example of this is where the members might requisition a meeting to be called of the members. So it's either a 5% vote or 10% vote of the members say, we want to hold a meeting, we want to make this proposal. You board, you've got 21 days to call the meeting. The board refuses to call that meeting, then the member can then go to court and the court would order the board to call the meeting. So it is actually possible to protect your board from litigation of the members by introducing an arbitration clause into your bylaws, saying if there's ever a dispute, we go to arbitration. And there are pros and cons to all of this. So the way you do it is through your bylaw drafting, you would opt into arbitration, and in doing so, you would opt out of litigation. If you go to litigation, the trial judge is the ultimate decision maker. If you go to arbitration, it's the arbitrator. And you can have arbitration provisions drafted where you seek and choose one arbitrator, or you have 3 arbitrators. The members would appoint one, the board would appoint one, and then you appoint a third neutral party who's agreeable to both the directors and the members, but that probably would be more expensive. It's easier to have just one qualified arbitrator. In terms of decision making, in litigation you have no control. Whatever the trial judge determines is what the decision is, and you must comply. In arbitration, you, again, you would have no control over the decision making, but you might have some control over who the arbitrator is. So you could select qualified arbitrators who have some sort of knowledge, expertise about the not-for-profit charitable sector, who might have more experience and expertise to offer to the issue at hand. In terms of the expense of all this, when you go to court, you're in a courtroom, that really is at the public expense, the use of facilities, and the cost of the trial judge. However, quite often in Ontario, it's the losing party who has to pay not only for their own legal fees, but also for the fees of the winning side. In arbitration, the expense is generally shared between the parties. So you could have an agreement where the directors and the members split the cost of arbitration. It's a little less risky. You can also rent some sort of neutral facilities for low cost, or you can see if there's other facilities that are available to you for free to carry out the arbitration. In terms of appeal, there have been examples where members have sued the board and sued the corporation, and it's gone to appeal. And one example is a hospital in the GTA area where it has gone to the Court of Appeal and could potentially go to the Supreme Court of Canada. And this proves for very, very costly activities and ensures that you're not really focused on what you want to focus on, which is your objects and your mandate. With arbitration, it's a final decision, it's binding, and there's no practical right of appeal. It puts the end to the issue. In terms of timing, courts are heavily backlogged, and it could take a long time to get a decision from a trial judge, and with arbitration, it's generally quicker. Costs with litigation, I would say it's very expensive. With arbitration, it's not cheap, but it's generally less expensive. And if you have a qualified, skilled arbitrator, it can be even less expensive. And public and private activities, courts are public, the documents filed are public. With arbitration, you can keep everything private. So there's just some considerations for you to think about as to whether or not you wish to include an arbitration clause in your bylaws. Now, save the best for last, and that's protecting the board from personal liability, because this seems to be the issue that most people are interested in hearing about and talking about and asking questions about. And so For those of you who are already well versed in this, I apologize, but I will go through the basics, and that's the duty of care of directors. So in the past, for both federal and Ontario corporations, directors have had a common law duty of care, and now with the new acts, they have a statutory duty of care. And the statutory duty of care set out in the acts requires the directors to act honestly, in good faith, and in the best interests of the corporation, and to exercise the reasonable care, diligence, and skill when carrying out their duties. And so what this means is when they're doing this, they have to ensure that they comply with the applicable act and the regulations. They have to comply with the corporation's articles and the bylaws. They have to avoid conflicts of interest. They have to subordinate personal interests to those interests of the corporation. And they have to, in every case, make sure that they are acting with due diligence. So due diligence is a word that lawyers like to throw around. And what does it actually mean? It means you are diligent in your decision making and you are following a process when coming to decisions. That's a reasonable process. So the most effective way for directors to discharge their fiduciary duties, and in doing so to minimize their risk of personal liability, is to perform their duties diligently, both individually and collectively as a board. And certain other actions also protect directors from liability when diligence is not enough, and I'll get to those in a minute. I just want to cover diligence first. So a director can be seen to be acting diligently if she knows the objects, vision, mission, values, and bylaws of the corporation. If she understands how resources are used and is aware of the functions and the acts of the officers. If she acts objectively, carefully, deliberately, and applies common sense when making decisions. If she carries out the duties of office only when acting as a director during board meetings. Now, this is something people forget. They think they're a director so they can go and speak directly to the CEO or a staff member or a committee member and say, here's what I think, this is what I want you to do. Directors do not have any sort of individual powers. They only have powers when they're acting collectively as a board. So that's something that you really need to consider and ensure that your directors are aware of. They can only act through resolution of the board. I said they must act in the best interests of the corporation. They have to disclose all personal dealings as early as practical. And both new acts have new conflict of interest provisions with some very clear requirements in terms of how conflicts of interest must be disclosed and how they must be dealt with. So I would highly recommend that you go through the act that applies to you, you look at your existing conflict of interest policies and bylaws and make sure that they align with the act. So a good director will insist on receiving accurate, comprehensive, and timely information so that that director can prepare for board and committee meetings and review all circulated meeting materials in advance. Now, this is the one place where I often see there's a gap in governance practices with my clients, and that is when staff members, through no fault of their own, circulate meeting materials at the last minute or presented on the day of the board meeting, slide materials under the noses of the directors and then ask for a resolution. It's not good governance practice. To the extent that you can, you should always defer the decision until the following board meeting, if it's practical to do so that you can ensure that your board is fulfilling its fiduciary duty and acting with diligence. Directors have a lot to read, and they have to make sure that they understand the materials and can ask the appropriate questions. So you have to, as a director, attend and participate in board and committee meetings. Now, I've had questions where people said, well, if I don't come, then I'm not responsible for the decision. Clearly, you all know that's not true. There are rules on dissent requirements in the statute now, and especially under the Ontario Act, in terms of when you need to dissent in order to have that dissent recorded in the meeting materials and the minutes to protect yourself from liability. So if there's some crazy decision that the board wants to pass and you fundamentally oppose it, you have to dissent within X number of days, and you have to make sure that your dissent is recorded in the minutes, or else it doesn't count. Directors need to make sure that they are making independent decisions and they're not simply being a rubber stamp of staff or committees of the board. Directors should refrain from voting or abstain from voting only when absolutely necessary, and that's typically the case when there's a conflict of interest. You can't abstain from voting because you can't say, oh, I don't understand the materials, I don't understand this or that, so I'm just not going to vote. That doesn't protect you from liability. Directors must review meeting minutes, and they have to insist that the meeting minutes record what actually transpired, and that it records any conflict of interest disclosures or declarations, any abstentions from voting, and any dissents from voting. Directors should insist on regular review of governance and operating policies. And they should obtain independent expert advice when necessary. When there's something that is beyond the knowledge or expertise of the individual directors on the board, individually or collectively, should get independent advice, because that will also protect you from liability. Directors need to insist on good audits and an effective audit committee, and they have to be aware to changing circumstances. So there's two other defenses that go hand in hand with the due diligence, and one is the business judgment rule. So essentially what the business judgment rule means is that the court is not going to second guess a board decision. The court, because hindsight's 20/20, and a board can make a decision that's a good decision, but that's not the best decision. All the board needs to ensure is that a good process was followed, that a reasonable decision was made based on information that was available, obtained, and sought out, and the court will then be satisfied that due diligence was completed and that the board exercised business judgment, which doesn't have to be perfect judgment. Reliance on others is also another legal defense for the board. So in discharging their duties, directors are not expected to have first-hand or expert knowledge about every single issue or matter that comes to the table. So what they can do is they can rely on management information if it's reasonable to do so. So if management presents certain reports, they can rely on them. Financial statements, auditors' reports, things like that, the board can rely on them. The only thing that the board cannot rely on that's presented to them by management is information that's suspect, or if there's a conflict between management's interest and the board's role. So my favorite example to use for this is when the CEO says, I want a raise, you're not paying me enough, I've done a survey, here's how much everybody else is making in my community, and you have to pay me, and here's my survey. Well, if you are truly contemplating any sort of salary increase, to the extent that you can, and there's some legislative requirements for some organizations where they can't raise these kinds of salaries, you need to do your own independent survey, independent of the executive director or the CEO, because that information could be suspect. Also, directors are not expected to be experts in technical areas, so there's nothing wrong with them relying on the advice of lawyers, accountants, engineers, appraisers, or others. What directors need to do is to make sure that the experts that they selected are truly experts in their field, that all of the information that should have been delivered to these experts so that to enable the experts to carry out their role was delivered to them, that they have an appropriate terms of mandate, so they're not asked to simply ask a discrete question where in the context of it they might have come up with a different answer. And they have to make sure that the experts provide written reports. And all of this will protect the board from liability. So essentially there are four main areas where directors can get themselves into trouble. And the first is wages and vacation pay. So under certain circumstances, and I won't go through all the details, but under certain circumstances, directors can be held personally liable if staff doesn't get paid for up to 6 months' wages or 12 months accrued vacation pay. Now, what has to happen is staff has to sue the corporation first, not be able to reclaim, or the corporation is going insolvent or is bankrupt, and that's when the staff might go after the board. So due diligence defense is not available. No matter what happens, the board is ultimately responsible for this, so I would strongly recommend that at regular board meetings, staff present to the board a report saying, yes, all wages, all vacation pay has been paid since the last reporting period. Taxes and other remittances is a similar concern. Directors can be held personally liable where employee income taxes or deductions for non-residents or HST, employer health tax, CPP, or EI was not made as appropriate. No director is liable for the failure of former directors, but a due diligence defense is available. So again, I would strongly suggest that management present the board with a certificate saying, yes, all of our taxes have been paid up to this reporting period. Environmental liability is another situation where directors can be held personally liable for any sort of release of a contaminant into the environment. So a due diligence defense is available to the directors. So to the extent that any of your organizations have environmental risks, you do need to ensure that you put some sort of an environmental management system into place and that you get regular reporting on where it works, where there might have been mishaps, and what's being done to deal with the mishaps. On occupational health and safety, again, if you're not in compliance with the Occupational Health and Safety Act, the directors could be held personally liable. And in the relatively recent past, there have been amendments to that act with respect to workplace bullying and harassment, where every organization needs to put in place policies and procedures to deal with this. So if you haven't done so, those provisions of the act do apply to you. You need to make sure they're in place and that you get a regular report from management saying everything's fine with this act. Indemnification is something that you can have drafted within your bylaws if you don't already, and I would strongly suggest that you review the applicable new act and the language of it and make sure that your indemnification provisions align, again, because the language is a little bit different from the old act. So the new acts both are identical, and they generally permit a corporation to provide an indemnity to purchase and maintain insurance for a director or officer of the corporation or a person who has acted at the corporation's request. The directors and officers can be indemnified against all costs, charges, and expenses incurred in respect of any civil, criminal, or administrative action or proceeding. The indemnity can survive the director's resignation or retirement, and it can include all legal costs that are incurred in resolving a lawsuit or defending a lawsuit or in paying a settlement for a claim. So I strongly recommend that these bylaw provisions are inserted. And over and above that, a lot of organizations don't have indemnification agreements between the corporation and the director, and I would recommend that you have those in place as well. These agreements can provide additional detail where if you have directors who are not able to sustain or defend the lawsuit on their own behalf, the corporation can advance monies for them. If it's found that the directors shouldn't have been held liable or shouldn't have been sued, then the directors stay whole if they have no out-of-pocket expenses. If it turns out that you have a rogue director who did breach a fiduciary duty and the suit was a legitimate claim, then that director really does need to reimburse the corporation for the monies that were advanced for the suit, because the corporation cannot indemnify a director if they didn't fulfill their fiduciary duties. Effectively, it covers any sort of claims for negligence. And finally, directors and officers' liability insurance should be put in place. And this will protect you because an indemnification is only as good as how deep the pockets are of the organization. You've got an insurance policy in place, you've got less concern. And for those of you who are charities, you just need to ensure that you comply with the Charities Accounting Act when you purchase and maintain this insurance, because that act sets out certain restrictions and requirements with respect to the insurance. So I am going to stop now. This question on liability, I will ask you to consider what you do to manage and limit your board's risk of liability. I think this is a good time now to break out. I think what we are asking you to do to talk amongst your tables in terms of the good ideas that I have introduced, your good ideas. You may have even better ideas than I've been able to come up with at today's session, and then we will regroup and we'll talk amongst us as a whole.